Yo, 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 fam. If you are buying multifamily deals in today's market and you're overpaying, you're not just hurting yourself, you're making it harder for everyone else. Too many inexperienced buyers are jumping in, pushing prices to unsustainable levels and creating a bubble. Or maybe that's even happened and it's still happening. If you don't know what you're doing, you're playing with fire and someone's going to get burned. So let's break it down. Who the heck is buying that deal? Hey everyone, welcome back to another episode of the Small Axe Podcast, where we chop down the biggest challenges of multifamily investing with small, consistent, yet mighty and beautiful efforts. Guys, today we're diving into a critical question. Who the heck is buying that deal? Question doesn't just matter to the seller, it's vital for investors, brokers, and even aspiring buyers like me and you trying to break into the multifamily game or scale up. We will explore today the key issue that is plaguing the market today: inexperienced and overly risky buyers inflating prices and making it harder for serious operators like you, like me, to compete. Let's break it all down. All right, so segment one, we're going to talk about the buyer landscape. Let's start with the big picture. Who's out there buying multifamily deals? Well, the multifamily market has a diverse set of players, right? So understanding who they are and how they think is key to navigating this industry. Here are some of the key categories. Institutional buyers, think about like REITs, real estate investment trusts, or large private equity firms. They're buying A-class properties, luxury developments, and large portfolios. Their motivation, they want stable, they want long-term growth and low-risk investments. They've got deep pockets, so they are not usually competing with smaller investors like you and me. Most likely, most of my listeners are smaller investors. Then there are syndicators and GPs, just like us. We're syndicators, or some of us are. I syndicate all of my deals. You guys know that by now. However, I'm looking to kind of get out of that. I don't necessarily want to syndicate forever. I'm not making much money as a syndicator. It's putting a lot of time, effort, and money into it and not getting much in return because the majority of the returns go to our investors, as rightfully so. But I got to take my licks at some point and then eventually perhaps be able to do my own deals, or at least change the way my deals are structured so I can actually make some money here. Syndicators like you guys or me, we pool together investor funds to purchase properties. We're looking for value add opportunities for the most part in some sort of way. Value add can be by renovating and increasing rents. It can also be operational inefficiencies, which you and I know is the best way to get involved. If we can take over a property that is just not functioning properly or has poor management, doing something wrong without putting much money into it, boom, we're golden. That's what we want. We want to deliver strong returns for our investors and earn some sort of fees along the way and partake in those returns as well as investors on the deal. So we get asset management fees. Sometimes we get acquisition fees. Sometimes we get equity splits if we perform properly. Remember, we have to perform in order for us to get money as syndicators. So be careful unless you're invested alongside your investors as well as an LP. I do that in all my deals. I highly encourage you to do that as well. However, if your capital is limited, your returns are going to be limited. Keep that in mind, please. All right, mom and pop investors, these are small scale buyers who often self-manage properties. And believe it or not, you get people like doctors, lawyers, dentists, you get professionals that are buying properties thinking that they're going to be able to manage these properly, and they don't necessarily. Not all of them, of course, but for the most part, they don't manage them properly because they're busy professionals, right? So they don't have the time to manage a multifamily opportunity, but they want to get involved. They understand that investing in real estate is important. It is a way to build wealth and grow wealth and preserve wealth, and they want to get involved. I get it. But it is not necessarily a game for everybody, especially a busy professional that is self-managing. So if you are a busy professional, you're buying multifamily deals, I highly recommend that you get a property manager. Some of them might be buying duplexes, triplexes, or even small multifamily. I've seen doctors come in and swoop up a deal for me, 6 units. I remember this was in St. Pete, I believe, or somewhere around there. Doctor came in, swooped it up, 6 units, and way overpaid. I knew exactly what it should have gone for. He overpaid because he thought it was a good deal based on uh, comparable duplexes and single family houses. A multifamily building has, let's say, 10 units. The units are going to be cheaper than a duplex. Like you might pay 250 for, or let's say 350 or 400,000 for a duplex. That's almost $200,000 a unit, or it is at 400,000. When I'm paying 80,000 to 130,000, let's say, a unit for a multifamily property. So be careful, guys. Anyway, they're motivated as well, these mom and pop buyers, to build long-term wealth and passive income as well. There are also 1031 exchange buyers, people who have just sold something and they're looking to roll that money into something else. If you're not familiar with what a 1031 exchange is, it is a vehicle that allows you to defer taxes to a later date. So you can buy a multifamily property. Well, let's say you just sold a property and you can buy a like kind investment property by rolling the proceeds of that property into a bigger, better, like kind asset. If you do that successfully, there are a lot of guidelines and things that you have to adhere to make it actually work. But if you do it, you will avoid capital gains tax for now. You'll kick the can down the road, which allows you to put your money to work a little bit more aggressively and faster. You got to be careful, though. There are deadlines to meet with that, but a lot of people use it. And I know a lot of people personally that have been very successful with a 1031 exchange. Then there are international investors, many people coming from abroad, out of the US, looking for real estate as a safe haven. And I was just listening to Ken McElroy's podcast with the milkshake theory, and it was great how they were talking about if interest rates are high. And I really like this, and I think it's important for us to note, if and when interest rates are high here in the United States, like they are right now, interest rates on T-bills, treasury bills, are also high. So you can get a good return on your money. Now, let's say you take that money from, they were mentioning Brazil, I believe, where there was like a 5% loss in their value of their Brazilian currency. Let's say they had a 5 or 10% loss. Now they're putting that money, well, first of all, let's say they put $1 million in last year to a T-bill, getting 5% for that year. Now their currency, their local currency in Brazil, just dropped or declined 10%. So their earnings are not actually 5% on the T-bill that they just earned 5% on. It is 15%, because once they buy back that money from their local currency, they just gained 15%. That's huge for investors. So a lot of people, when they see rising interest rates in the United States, they're going to invest in the United States, which is good for us as an economy. Then there are owner operators. So these buyers are in it for the long haul and prefer to self-manage their properties. They are vertically integrated. What's their focus? They want steady cash flow and control over the property. Okay, they want to be able to live off the proceeds and manage everything. It's like a business, right? So think about a business owner who is just living off the proceeds, living off their earnings. This is what these people do. All right. Now, what motivates buyers? All right. So why are these players involved? Why are they buying? The motivations often dictate the strategies and willingness to pay. Here's some key drivers: cash flow versus appreciation. Institutional buyers may prioritize appreciation, while syndicators and mom and pop investors often focus on cash flow. Also, we have to understand everybody's risk appetite. Value add buyers take on more risk in exchange for higher returns or potential returns, because it's not always the case. In contrast, core buyers stick to stable, lower risk assets. Now, market conditions also play a huge factor here in the success of investors. So rising interest rates, economic uncertainty, and local market trends all influence who is buying and what they're willing to pay. 1031 exchanger buyers, rather, and syndicators often face time constraints, like impacting their negotiation strategies and not permitting them to be as flexible as, let's say, the institutional buyers, where they're looking to place capital. Let's jump into segment 3. Inexperienced and overly risky buyers. If you don't know that they're out there, you're crazy, because the prices have been ridiculously inflated by these losers. Now, let's address the pressing issue in today's multifamily market. Guys, there are people out there that are just willing to pay too much for assets. Now, I think that there has been an overwhelming amount of syndication groups or education groups or mentorship programs, coaching programs to teach syndications, where now everybody feels that they should be syndicating deals. When you know me, I've spoken about this dozens of times on the podcast. I don't feel that everybody should be a syndicator. I don't feel that everybody should be investing in multifamily. If you're listening to my podcast, and if you listen to my podcast religiously, you should be investing because you're caught up. You're willing to learn. You're willing to grow. You're willing to try things and listen to real advice. But those people who were listening to so-called gurus promising overnight success, 6 months to retirement, you're insane. That's not the case with multifamily. This is a long-term game, guys. They're entering deals without fully understanding underwriting, cash flow projections, or risk management. As a result, they're overpaying. These buyers inflate prices, making it difficult for serious operators like me, like you, to compete. They are unsustainable returns. They promise high returns to investors, but fail to account for rising expenses, rising interest rates, perhaps economic downturns like we're currently experiencing. And if you think it's not happening, you're crazy, then you don't have your finger on the pulse. Vacancy is up, supply is up in certain areas, especially where I am focusing on in Florida, and the vacancy has been up. Now, we have been able to combat that with extreme advertising and working really hard on leasing. So we're beating the norm. However, there's still issues with delinquency. Now, delinquency is a thing. So if you're not familiar with delinquency, it's when somebody doesn't pay their rent. Sometimes they're just late and that's acceptable. Sometimes there are real reasons, and sometimes they just don't pay the rent. Maybe they're just not inexperienced. Maybe the people that are just not paying the rent are just not good with handling their money, which is most likely the case. Now, also, it could be market specific. It could be neighborhood specific as to why the delinquencies is up, but they're also up across the United States, in my opinion. And what I have seen with speaking with many operators is that delinquency is up because people are losing jobs or taking pay cuts or just not able to pay rent because rents have gone up 16-30% over a couple of year time frame, and we need to catch up to that. So people are getting a little bit over their head with their rents, right? They're not necessarily making enough money to pay their rents, and then they're making poor decisions, financial decisions, or buying weird things or TVs or devices that they don't necessarily need, but they feel like they need. Anyway, so delinquency is up as well. Now, how does this impact the market overall? So this drives up prices across the board, creating like a bubble effect and putting pressure on real estate operators like you and I who focus on the fundamentals. And I've seen deals where buyers ignore negative cash flow or zero cash flow or even negative cash flow of speculative appreciation. So they are looking towards appreciation to save them. Now, let me be clear. Multifamily investing, guys, just like I said before, just like I said on last episode, is a long-term game. It requires discipline, strategy, willingness to say no to bad deals, even if it means waiting longer to find the right one. Okay. Be patient, be persistent, educate yourself, and it will come. So, how do you stand out in this crowded and often chaotic market? Here are some of my top tips. First of all, I think you really need to go back to education. If you're not fully educated, especially on the underwriting portion of multifamily investing, you're in trouble. You got to know your numbers inside and out. You got to focus on deals that cash flow from day one, if possible, or month 6 or month 12 by the latest. You have to be cash flowing unless you're doing a development deal, which is very different. You have to be cash flowing and leave room for unforeseen expenses because we never know what expenses are going to creep up. So I harp on cash flow, and I didn't in my earlier journey. I didn't think cash flow was that important. You know why? Because I didn't need it. I have a W-2. So through that thought process, cash flow is not necessarily needed for me to be successful. However, it is necessary for the deal to perform successfully, to pass any road bumps or any issues that could happen. If a deal is just barely cash flowing, one small thing can mess up an entire deal or have you be pull, at the very least, have you pull money out of pocket just to float a deal. You want to stay away from pulling money out of your own pocket at all costs. So stay disciplined here, guys. Don't just chase deals because others are bidding. Stick to your numbers, stick to your investment criteria, and walk away from an overpriced asset. I do it all the time. I underwrite hundreds of deals. You might get one deal for every 100 that you underwrite. I'm on underwriting like number 600 at this point. How many did I close? 3. What does that tell you? It tells you to chill out. Okay. Work on building your credibility kit. Something that I actually have now available for you on my website is called a credibility kit. So many people in the beginning of their journey run into trouble building credibility. They are unable to speak with brokers. They're unable to get any sort of clout or movement or engagement, even with a broker, to be able to look at deals and negotiate deals, bid on deals, and eventually close on a deal. Okay. So, what I've created to combat this is called a multifamily credibility kit. The first couple of years of my journey, I spent networking with so many new investors and people just to get to know people and do what you got to do. You have to network with people. And everybody was asking about, how do I get credibility with a broker? And I gave away what's called a one pager for years, guys. I made my one pager in 2020. It is now 2025. I've been giving it away for free for years, and I'm still giving it away for free. I actually just updated the one pager, and you can get it with a simple link. It's a click of a button. It'll open it up right for you as a template in Canva, and I will give a video of how to edit it and make sure it matches your branding and all that cool stuff. And you're going to use that to show or showcase why you should be considered as a potential buyer for these brokers. And this is only a small part of my credibility kit. This credibility kit is going to be available on my website. You click sign up for my emails or whatever it is. It's my lead magnet. You click on it, you sign up, you will get my credibility kit delivered right to your email today. If I have it ready, it might not be ready for another week or so, but I'm basically there. You sign up for it, you click it, you get a credibility kit. I tried to compact, I've been working on it for a while. I tried to compact everything into the most powerful things that you need to get credibility with brokers. There's a variety of tools available for you, which is all for free, as well as flashcards to help you build your vocabulary when speaking with brokers. I have scripted emails for you to give to brokers. I have this template, which is a one pager, which you're just going to literally plug and play, attach it to your emails. You will see your credibility skyrocket. Okay. Now, if you don't have a track record, I give you advice for dealing with that. If you don't have any deals prior, I give you advice for that. If you are literally brand new, this is your first day listening to a multifamily podcast and you want to get involved, I give you resources to get involved right now. It was my ultimate goal to give value, and I hope that this gives as much value as possible. My multifamily credibility kit, go to my website, smallactscommunities.com, to find it. Now, you're going to be dealing with brokers all the time. You're going to be dealing with off-market deals as well, but brokers typically hold the deals. So you want to build rapport, build relationships with brokers. And brokers only want to work with serious buyers who can actually close a deal. So you don't know how to do that at this point. Let's say if you're brand new and you need to build trust by being transparent, professional, consistent. I show you exactly how to do that with my credibility kit. Throughout this process, you need to continue to educate yourself, learn from experienced operators. You need to be talking to people, seeing how their deals are going, listening to podcasts, reading, educating yourself, etc. Not hype-driven gurus. There are amazing gurus out there. I work with some of them. I partner with some of them, and I am a mentee of some of them. But then there are others who are just out there trying to make money and not really actually participating in this game. So just be careful. Understand what it takes to succeed in this industry and take a long-term approach. Guys, the multifamily market is competitive as heck, and the rise of inexperienced buyers is adding fuel to the fire. But by staying disciplined, educated, and focused on the fundamentals, you can navigate these challenges and find great opportunities. Why? Because they're out there. How? Put in the reps, put in the work, get my credibility kit, start working. I will help you. You got this. Now, remember, guys, it's not about buying just any deal. It's about buying the right deal. That's how you build a lasting empire with your small axe. Now, that's all I got for you guys for today. I hope that you have found it somewhat helpful. And if you did, please leave me a review. I have literally like almost 100 reviews I think I have like 89. Please leave me a review. It would mean the absolute world to me, guys. Share this episode with somebody. I'm looking to grow this podcast now that I'm feeling more confident, now that I've closed 4 deals, now that I've gone full cycle on 194 units, now that I've seen ups and downs and terrible times and decent times and cash flowing deals and barely cash flowing deals. I am ready to share this stuff with the world. So please share this episode with somebody who's looking to break into the multifamily game. Now, until next time, keep chopping down those challenges with your small yet sharp and mighty axe. Love you. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.